Here's a mistake that costs LLC owners thousands of dollars every single year, and almost nobody talks about it. They set up their LLC, they start making money, and then they just pull cash out of their business account whenever they need it. No structure, no strategy, no plan, and then April comes around and the IRS hits them with a bill they were completely unprepared for. Here's the thing, how you pay yourself from your LLC is not just a preference, it is a tax decision, and if you get it wrong, you either overpay in taxes or worse, you trigger an IRS audit. And on this channel, we break down LLCs, legal strategies, and business finance in a way that actually makes sense. Today, we are going deep on one of the most misunderstood topics for LLC owners, the difference between an owner's draw and a W-2 salary. Which one saves you more money and which one is right for your situation. By the end of this video, you will know exactly how to pay yourself the smart way, so stick around, this one could literally save you thousands. What is an owner's draw? Let's start with the most common method, the owner's draw. An owner's draw is exactly what it sounds like. You are the owner of the business and you simply draw money out of the business for personal use. There's no paycheck, there's no withholding, there's no HR paperwork. You move money from your business account to your personal account, and that's it. Now by default, if you have a single member LLC or a multi-member LLC, the IRS does not treat your business as a separate tax entity. This is called pass-through taxation. Your business profits pass directly onto your personal tax return. So here's what that means practically. Even if you don't take a draw, you still owe taxes on what the business earned. Let that sink in for a second. The owner's draw is not a salary. It does not reduce your taxable income. It is simply you accessing money that is already yours. Now, the biggest thing you need to understand about owner's draws is self-employment tax. As an LLC owner taking draws, you are responsible for paying 15.3% self-employment tax on your net business income, on top of your regular income tax. That 15.3% covers Social Security and Medicare, which an employer would normally split with you if you were an employee. But when you own the business, you pay both sides. What is a W-2 salary? Now let's talk about the W-2 salary, and this is where things get really interesting. A W-2 salary means your LLC pays you like an employee. You run payroll, you receive a paycheck, taxes are withheld, and at the end of the year you get a W-2 form just like any traditional job. But here's the catch, a standard single member or multi-member LLC cannot pay its owner a W-2 salary. The IRS does not allow it under the default LLC tax structure. So when does a W-2 salary become possible, and more importantly, when does it make financial sense? The answer is when your LLC elects to be taxed as an S-corporation. When you make the S-Corp election with the IRS using Form 2553, your LLC is now treated as a corporation for tax purposes. And as an S-Corp owner, the IRS requires you to pay yourself a reasonable salary. That salary shows up on a W-2, payroll taxes are withheld. You do it right. But here's the magic of the S-Corp election. Any profit above your salary is distributed to you as a shareholder distribution, not as wages. And shareholder distributions are not subject to that 15.3% self-employment tax. That is where the savings come in. The tax difference explained. Let me make this crystal clear with a real example, because this is where the money is. Let's say your LLC nets $150,000 in profit this year. Scenario A, standard LLC with owner's draw. You take draws throughout the year. Your entire $150,000 is subject to self-employment tax at 15.3%. That's roughly $22,950 just in self-employment tax before you even touch income tax. Scenario B, LLC taxed as S-Corp with W-2 salary. You pay yourself a reasonable salary of $70,000. The remaining $80,000 is taken as a shareholder distribution. You pay self-employment taxes only on the $70,000 salary, roughly $10,710. The $80,000 distribution, zero self-employment tax. That's a savings of over $12,000 on self-employment tax alone. Now I want to be clear, reasonable salary matters. The IRS is not going to let you pay yourself $1 in salary and take $149,999 as a distribution. They will audit that. You need to pay yourself what the market would pay someone doing your job. But within that structure, the savings are very real. The S-Corp election typically starts making sense when your LLC is netting $40,000 to $50,000 or more per year. Below that, the cost of running payroll might outweigh the tax savings. Which one should you choose? Alright, so which method is right for you? Here's a simple framework. Choose the owner's draw if your LLC is new or still growing. Your net profit is under $40,000 per year. You want simplicity without payroll software or accountants yet. You are in the early startup phase and cash flow varies month to month. Choose the W-2 salary S-Corp election if your LLC is consistently netting $50,000 or more per year. You want to maximize tax savings on self-employment taxes. You are ready to run proper payroll and maintain corporate formalities. You want to build social security credits and potentially offer yourself benefits like health insurance deductions. Now here's the part where getting the foundation right matters most, and that starts with how your LLC is structured and maintained. If you haven't formed your LLC yet, or if you need to update your registered agent, operating agreement, or compliance filings, this is the time to do it right. Services like Northwest Registered Agent are excellent for Privacy First LLC formation, while ZenBusiness offers one of the most affordable and complete packages for new LLCs. If you want legal support baked in, LegalZoom and Rocket Lawyer are trusted platforms that give you attorney access alongside your formation. For fast filings, Swift Filings is one of the quickest in the game. Inc Authority even has a free LLC formation option if you're budget conscious. If you're building a brand alongside your business entity, Tailor Brands offers a bundled branding and LLC package. For ongoing compliance management, especially if you're in multiple states, Harbor Compliance is top tier. And if you want smart business tools and financial management in one place, check out Breezy. Links to all of these are in the description below. Most of them I've reviewed in detail on this channel. Let me wrap this up with the 3 things I need you to remember from this video. Number 1, your LLC structure determines how you can pay yourself. Default LLC means owner's draw. S-Corp election opens the door to a W-2 salary with major tax advantages. Number 2, the owner's draw is simple, but it does not protect you from self-employment taxes. Every dollar of profit gets taxed at 15.3% on the SE side unless you elect S-Corp status. Number 3, the S-Corp election is not for everyone. It makes the most sense when you're consistently profitable at $50K or more per year. Below that, the payroll costs may cancel out the savings. Here's my challenge to you. Go look at what you netted last year. If it was over $50,000, run the numbers on an S-Corp election. Talk to a CPA. This one decision could be the biggest financial move you make for your business this year. If this video helped you, hit that like button. It helps more business owners find this content. Subscribe if you haven't already, because every week we cover LLCs, legal strategies, and business finance in plain English. And drop a comment below. Are you currently taking draws or are you set up with an S-Corp? I read every single comment. I'll see you in the next one.